Hey guys, welcome back to another edition of Founders Corner. I'm your host Neil Macadia with N5 Solutions, where we help IT companies like yourself with all their accounting needs. So today, I'm pretty excited to talk about today's topic. We kind of want to go through accrual versus cash accounting. This is a pretty big, popular topic because a lot of times when we get clients come in, a lot of them come in as cash basis, and then we tell them that they need to really follow accrual accounting, especially when they're trying to go for fundraising rounds, because investors definitely look into having your books in accrual basis. So what is accrual accounting, you say? So accrual accounting is basically just a system of accounting where all your revenue and expenses are recorded when they're earned or when they're incurred, not necessarily when the cash is received or paid. This helps you create more of an accurate picture of your company's financial statements because you're matching all your revenue and your expenses in the correct months. And then this also helps investors, anyone helps you as an owner kind of know where your numbers are going, why you're not profitable. By doing cash accounting, that kind of really, because you could have revenue one month and then you could have all your expenses paid another month. So when you try to look month over month, you can't really see any trends. So here it kind of goes more detail. So with accrual accounting, revenue is basically recorded when it's earned and when either cash could be collected or is reasonably assured of collections. So if you sold something and you know that the customer's not going to pay, you really shouldn't record it as revenue. But if you kind of know that, yeah, this is my regular revenue that I'm going to be doing every single month, that's going to be collected, then you should definitely record it. And costs and expenses are the same. Costs and expenses occurred, whatever costs and expenses you have that incurred generating the revenue must be reported in the same period. This process is called matching the expenses to the revenue. So for example, if you have service industry, if you did some kind of installation and then you had a contractor do the actual installation, you want to recognize the expense the same month you recognize the revenue. This way you get more of an accurate picture. And cash accounting is what a lot of people start off with. Even in QuickBooks, I think a lot of times they go into cash accounting, not even realizing they're in cash accounting. With cash accounting, you could still have cash accounting for your tax purposes, because a lot of times you could have some tax savings on tax purposes, so you could file your books on cash basis, and then but reporting wise for internally for yourself and for your investors, I would recommend doing accrual basis. So here with cash basis, revenue and expenses are recognized once only when cash is received or when payment is made. This is mainly used for small businesses. So a lot of times, like if you were just a contractor that had your own little business or side hustle that, you don't really care about growing your business or having investors, cash accounting, it just makes it easy. You just try to track all what you got paid and what you expensed. So at the end of the year, when you file your tax return, it makes it easier. But that's not really the proper way if you're trying to grow your business and then grow it professionally. So here is kind of an example of how your books could look really different. Let me move this over here. So here is just an example. So in March, company ABC basically performed services for customer X for $110. And then they invoiced the customer the same month. Customer didn't pay it till May. So they took 90 days pretty much to pay. And then contractor A also performed the work related to service for $100 in March, and we paid them in April. So accrual basis, you can see how it flows. So this is our beginning bank balance. So we have accounts receivable 110 because we invoiced the customer, and accounts payable is we basically owe that contractor. So here you see that the gross profit kind of makes sense because you have the revenue, cost, gross profit, and your gross profit margin. And then after that, once you already record everything on your P&Ls, or you recorded everything else, after that is all balance sheet related. So here you see in April you paid the vendor, so your bank balance is zero now, but you have AR collected, and then in May is when you collected on the AR. So then now you have basically $110, which is what you were expecting to have, because you sold something for 110, you had to pay $100. So at the end, the net things, you made $10 profit on that one transaction. So your new bank balance should be 110 at the end. Versus cash basis, see how kind of messy it tells you, like your bank balance is 100. In March, you basically didn't get any revenue or cost because you didn't collect on that. And then April, your cost was $100. And in May, your revenue is 110. So see how, like, if I'm trying to compare month over month, there's no way of really saying, hey, am I profitable? Because April it seems like you lost money. And then at the fact too, when investors look at it, if you gave your books to investors in April, they'd be like, hey, what's going on? You basically have $0. Where's the revenue? And you would have to explain, oh yeah, no, it's gonna come. We're gonna get paid, and we already did some services. That's gonna come. But if you look at this, you could give the investor this anytime. Even if you give the investor in March, the investor will know, oh yeah, look, he has $100. There's AP that owes. There's AR. If I net him, I know he'll have 110, and I can see everything is all clean. So it makes a huge difference. It tells the story of a financial a lot better when you have it all properly, organized in an accrual basis. So that makes a big difference. And then, so just to want to summarize this, so the main reason why you want to use accrual basis is because that follows GAAP accounting, general accepted accounting principles. A lot of times when you're with investors might even audit your books. They might have auditors come, and the auditors need to make sure your books are in GAAP compliance. And then by switching over to accrual basis, that will ensure you that you're properly recognizing revenue and expenses. Accrual basis also gives a better measure on a firm's performance that cash doesn't really show. And then by doing this, like we saw in the last example, you could actually see the flow of how the numbers are going. And then investors also want to look for more accurate financials, and that's why they switch to accrual basis. So that's one of the things that they look for. So and that's pretty much in a nutshell. So if you have any other questions or concerns, please just comment below, and then you will definitely going to be able to address it. I know some of the key questions that you get a lot is like, hey, midway, could I switch to accrual? And there's definitely, you could switch any time of the month. Some people wait till the end of the year if it's already closer to the end, and they'll switch in the following month, just so like they know reporting month over month of last year versus this year. You can even go back even for like past history and redo the books if you want. That just, I guess, will cost you, but it depends on how, you might need it. Sometimes investors want like a 5-year history of your financials, so you might have to do accrual basis. But like I said, if you have any other questions or comments, just write them down below, and we're happy to help. And if you have anything else, let me know. All right, and that, I hope you enjoyed today's session, and then we'll talk next week. All right, take care. Bye.